Today we're talking about how banks actually decide your mortgage rate and why two people can get totally different numbers even when rates are 7% on the news. I'm Sean and I make money easy so you can escape the rat race and live like a Saturday every day. Your mortgage rate decides how much interest you're going to pay and how much home you can actually afford. So most people just call a lender and ask what today's rate is, and then they just take that number at face value. But if you understand how that rate is built, you can take back control and possibly even lower it. So if you're buying a home soon, stick around. I'll break down the 5 biggest factors banks use to decide your rate, when you can control and for what you can. So let's jump in. Before we dive into the 5 factors, you need to understand one key formula. Your mortgage rate isn't some random number a lender picks out of thin air. It's based on a simple equation. It's going to be your market baseline plus your risk profile, and that's going to be your mortgage rate. So the market baseline is the part that you can't control. It's shaped by the bond market, inflation, and overall economic conditions. And yes, the Federal Reserve influences it through its policies, but they don't set your mortgage rate directly. And then your risk profile is all about you. It's going to be your credit score, your down payment, your loan type, and even the property type you're buying. So if the market baseline is around 6%, a low risk borrower might get 6.25%, while a higher risk borrower might end up closer to 7.5%. So that's why two people buying similar homes can get completely different rates even when rates are 7% on the news. So right now I'm going to break down both sides of this formula, starting with the market side and then the personal side. So the first factor is the market baseline, and it's the big one and the piece that sets it for everyone's rate. And let's start with what it actually means. The Federal Reserve, or the Fed, is the US central bank, and one of their main tools is setting the federal funds rate. And that's the rates that banks charge each other for overnight loans. So that's a very short-term rate, not a mortgage rate. But it has ripple effects across the entire financial system, credit cards to car loans to mortgages, because it changes how expensive it is to borrow money in general. So here's how it works. When the Fed raises the federal funds rate, it's trying to fight inflation by slowing down spending. And when the Fed cuts the rate, it's trying to stimulate the economy and encourage borrowing. But the mortgage market doesn't follow the Fed's rate directly. Instead, the mortgage rates follow long-term bond yields, especially the 10-year Treasury note. So that's because most 30-year mortgages are paid off or refinanced within about 10 years. So when the Fed raises short-term rates, investors expect higher inflation and higher future yields. And that pushes up long-term bond rates, which in turn pushes up the mortgage rates. And when the Fed lowers the rates, the opposite happens. Long-term yields fall and mortgage rates tend to follow down as well, though not always at the same pace. So here's how it looked recently. In 2020 and 2021, the Fed funds rate was very, very low, close to 0%. And the 10-year Treasury was around 1%. And then during that time, an average 30-year mortgage was around 2.65% or 3%. And in 2024 and 2025, the Fed's fund rate has increased to 5.25%. So now the 10-year Treasury is near 4.5%, and the average 30-year mortgage is between 6.5 and 7.5%. So notice how they all move in the same direction, but not necessarily by the same amount. Mortgage lenders add a spread, usually around 1.5 or 2.5% above the 10-year Treasury yield to cover the risk, their servicing, and their profit. So that's why the Treasury is at 4.5%, you might see mortgage rates near 6.5 to 7%. So even though the Fed doesn't set the mortgage rates, its actions influence them through this chain reaction it causes in the bond market. And unfortunately, you can't control this part, but understanding why the rates move helps you make smarter timing decisions when buying or refinancing. So if you got a mortgage in 2021, you probably locked in a rate at 3%, which is amazing. And if you applied in 2024, then you're probably getting around 7%. And that's a 4% difference purely from timing. You know, it's gonna be the same borrower, same house, but a much higher monthly payment and lower approved loan amount. The Fed and the bond market together create the baseline, the part that you can't control. So now let's get into the parts that you can. So factor number 2 is your credit score. And this is the biggest personal factor that lenders look at. Your credit score is basically a trust score. It tells lenders how risky it is to lend to you based on how you've handled debt in the past. And scores range from 300 to 850. The higher the score equals the lower the risk equals the lower the rate. Lenders typically group borrowers into different tiers. An excellent tier would be above a 760 credit score, and you're probably gonna get the best rates available. A good score is between 759 and 700. So slightly higher rates, but again, not too bad. A fair score is between 699 and 650. Again, noticeably higher rates. And then poor is something below 650. So you're gonna get much higher rates, or you might not even qualify for a loan at all. So let's see what this looks like as an example. So imagine you have a $300,000 mortgage over 30 years. If you had a 780 credit score at 6.5%, then your monthly payment would be $1,896. And over 30 years, you're gonna end up paying $382,633 in total interest. But if you had a 680 credit score when you got this loan, then you probably get the loan at 7.5%. And that means your monthly payments are $2,098, and the total interest that you have to pay over 30 years is $455,151. So that's a $202 a month difference, or $72,518 more interest over the life of the loan, just because of your credit score. So why do banks care so much about your credit score? Because this score predicts the likelihood that you're going to pay them back. Someone with a 780 score has proven consistency, whereas someone with a 680 score might have missed payments or carry high balances. So that extra risk gets priced in as a higher rate. So the good news is you can totally control this. So here's how to prove your credit before applying. 1, pay all your bills on time because payment history makes up 35% of your score. 2, pay down your balances, keep your credit utilization below 30% of your limit. And 3, avoid getting new loans or credit cards right before applying. Each new inquiry can ding your score temporarily. Even a 20 to 40 point bump can save you thousands of dollars over time. So before you shop for rates, try to fix your score as best you can. It's the easiest lever to pull. Factor number 3 is your down payment or your loan to value ratio. So your down payment directly affects your loan to value ratio, the percentage of the home's value that's financed. Lenders love low LTVs because it means there's equity protecting their loan. Now, a higher down payment equals a lower LTV equals lower risk, which means that you're gonna get a better rate. And just like the credit score, banks like to bucket people into different tiers based on the LTV they get for their loan. So if your loan to value is 80% or lower, then you're typically gonna get the best rates. You want to pay PMI or private mortgage insurance. But if you want to put down less down payment, like just 10 to 19%, then your LTV will be 81 to 90%. So you're gonna get slightly higher rates and you do have to pay PMI. And if you only put in 10%, then you also have to pay a higher rate and higher PMI. So here's an example with a $500,000 home. Scenario 1, 20% down, so your down payment is $100,000 and your loan amount is $400,000. The rate here is gonna be 6.5%, so your base payment is $2,528. You also have no PMI, so your total payment per month is $2,520. Second scenario is only 5% down, so your down payment is $25,000. Your loan amount is going to be $475,000. Your rate is going to be a little bit higher at 7%. So your base payment is going to be $3,160 per month. Now, because your down payment is under 20%, you will pay PMI on this loan. So you might have to pay an additional $142 as insurance to the lender. So your total payment is going to be $3,302 per month. So that's a $774 per month difference just because of the down payment gap. Now, why is that? Well, it's because if you only put down 5% and the home value dropped 10%, then you're underwater. You owe more than what the house is worth. So that risk is priced into your rate. So if you can save for at least 10 to 15% down, it can make a huge difference. But I want to emphasize, do not wipe out your entire emergency fund just to avoid PMI. Sometimes it's smarter to accept a slightly higher rate and keep some cash reserves. You can always refinance once your equity grows past 20% to remove the PMI. Factor number 4 are the different loan types. Not all loans are created equal, and the type you choose plays a big role in your rate. So here are the main categories. You have conventional loans, which is the most common type, offered by banks and credit unions, and typically backed by Fannie Mae or Freddie Mac. These usually have the best rates if you have strong credit, like above 740 and 20% down. Then you have FHA loans, which are backed by the Federal Housing Administration. So they allow smaller down payments as low as 3.5% and have more flexible credit requirements. But you do need to pay mortgage insurance premiums, also known as MIP, upfront and monthly for the life of the loan. Next, you have VA loans. Now these are loans for veterans and active military. With a VA loan, you can buy properties with 0% down, no PMI, and they usually offer the lowest rates, even lower than conventional loans. They do have a one-time funding fee, but you can't roll that into the actual loan itself. Then you have jumbo loans, and these are for loan amounts above the conforming limit, which is about $750,000 in most areas. And because these loans can't be sold to Fannie Mae or Freddie Mac, lenders take on more risk, so rates for these are usually a little bit higher as well. So let's see what this means for a $500,000 home. So the conventional loan, let's say you put 20% down, your credit score is 760, and you have a rate of 6.5%. Your base payment here is going to be $2,528. You can have no PMI, and your total is going to be $2,528 a month. With an FHA loan, you might put down 3.5%, your credit score might be 680, so your rate is going to be 6.75%. Your base payment is going to be $3,129, and paying MIP will be $312 a month. So your total here is $3,441. And with the VA loan, let's say you have 0% for the down payment, a 720 credit score, and your rate is 6.25%. Your base payment is $3,078. You have no PMI, so your total is $3,078. So do you see how different that is? The VA loan actually has the lowest rate, even with 0% down, because it's government backed. The FHA loan, despite a competitive rate, ends up being the most expensive once you factor in insurance. And the bottom line is, every program has its trade-offs. So if you have great credit and a healthy down payment, then go conventional. If you have limited savings or lower credit, go FHA. If you qualify for a VA loan, try to get a VA loan. It's usually the best deal on the market. So always compare not just the interest rate, but the APR, the annual percentage rate, which includes the fees and the insurance. Factor number 5 are property type and discount points. So this category usually includes smaller details that still affect your final rate. So lenders charge different rates based on what type of property you're buying and how you'll use it. So if you have it as a primary residence, then you're gonna get the lowest rates because again, you're most likely to pay it on time. If it's a second home or vacation home, it's a slightly higher rate, but it's not that bad. And then for an investment property, usually you have to pay a small markup, 0.5 to 1% more than a primary home, since landlords are more likely to default during financial stress. Even the type of property you buy determines your rate. So a single family home is the lowest risk and it has the best rates. Condos or 2 to 4 unit properties, it's gonna be a slightly higher rate because they're harder to resell and sometimes depend on the HOA stability. So as an example, let's say you have a primary single family home and the rate is 6.5%, your monthly principal and interest payments is $3,160. But for an investment property, that rate might jump to 7.5%. So now for the same type of home, you're paying $3,496 a month. So that's a full 1% difference just based on the use. And now we have discount points. So this is where you can buy down your rate by paying extra upfront. Each discount point costs 1% of the loan amount and typically reduces your rate by about 0.25%. Now these discount points vary a lot by the lender and the day. So for example, on a $500,000 loan, let's say your base rate is 6.5%. So your monthly rate is $3,160 a month. If you pay 1 point, which is 1% of $500,000, so $5,000, then your rate drops to 6.25%. So now your monthly payment is $3,079. So by doing this, you save around $81 a month. So to find your break-even point, divide $5,000 by $81, and that equals to 61 months, so around 5 years. So if you plan on staying longer than 5 years, then buying a point can make sense. But if you do plan on selling or refinancing sooner, then you should keep your cash instead. Personally, I prefer having more cash on hand, and I'll just refinance later if rates drop. But why do these two factors matter? Banks use property type and points to manage the risk and profit. Investment properties are riskier, so higher rate. Condos depend on the HOA health. So again, higher risk, slightly higher rate. Discount points give banks cash up front, so they reward you with a lower rate. Now, these don't usually make or break your deal individually, but together they can shift your rate by a full percent or more. Let's put everything together with real numbers. Let's assume the market baseline is around 6%. So scenario 1, you have a low risk borrower. They have a 780 credit score, so you drop the rate by 0.25%. Their down payment is 20%, so you don't add anything to the rate. The loan type is conventional. Keep the rate the same. The property is a primary single family home. Again, keep the rate the same. And they pay 1 discount point, so you drop the rate by 0.25%. So their final rate here is 5.5%. Scenario 2, it's a little higher risk borrower. Let's say their credit score is 680, so you add 0.75%. The down payment is just 5%, so you increase the rate again by 0.25%. The loan type is FHA, so in this case, no rate adjustment. And the property type here is a personal residence, so your final rate is 7%. So that's 2 borrowers, 2 different interest rates, and 2 different monthly payments, all because of these personal factors that they can control. So when you hear someone say that mortgage rates are 7% right now, what they really mean is that average borrowers are getting around 7%. Your actual rate could easily be a point lower or higher depending on your risk profile. If you're in the market to buy a new home, or if you're curious about where rates are today, check out goodsweethomes.com/home loans or click on the link in the description. And if the rates are lower than what you already have, it's a good chance that you'll be able to refinance your loan for free. So now that you know how your mortgage rate is built, you can stop leaving money on the table, improve your score, play the game smarter, and start stacking real wealth so you can live like a Saturday every day. Thanks for watching, you guys. I appreciate you, and I'll see you next time. Take care.